Good morning, EXP, Realty Commercial Mastermind Group, commercial agents, and everyone else who has chosen to join us this morning in the boardroom. This is Eric Bell. Let me first thank Robert Kramer for introducing me to EXP, and Jen Frost, who has been instrumental in helping me get acclimated and into this century on the technology front. Jen is also helping me record this presentation for you. I will be around afterwards to answer questions. I am a California broker, but practicing real estate is not my core business. Robert asked me to come on and be a resource to all of you. I met him about a year and a half ago at the Anaheim Convention Center when I was speaking on this same topic. I'm about to introduce to you what is called the Monetized Installment Sale Transaction, or M453. I'm under the impression that some clients may not be able to move forward on a possible 1031 exchange because they cannot find the cap rate or like property within the 1031 guidelines. The monetized installment sale will give your clients the liquidity to buy what they want and when they want to, so they can buy the next property at their time frame, not the constraints or restrictions of the 1031. So the regulations, restrictions, requirements, and more importantly, the rush of the 1031 is now gone. You will be able to sell the property and sit on the cash while you help your client find and purchase the next property. And we all know cash is king in a new purchase. Let me take you through it. What I have here is a capital gain tax map for the country. I know people across the country are listening. It's important that we see this. All the tax brackets are underestimated. California, for example, is actually 37.1. So we're missing a couple percentage points there. I don't know how accurate Texas is. I think it's off a point or two. But here you see all the different tax brackets across the country. This can be done for any privately held asset, the M453. M is for monetized, that has been copyrighted by a DCA, Dealer in Capital Assets, which is equivalent to a qualified intermediary, or what you may know as the old terms accommodator. 453 is the tax code for an installment sale. This was created 25 years ago by a Harvard-educated attorney named Stanley D. Crow. Stan created this up in the Pacific Northwest, and one of his clients was selling raw land to developers that were going to build on it some condos. I'm going to use 10 million as a round number just so we can keep our math simple. What you see there now is that the buyer and the seller must have an agreement. So they're in escrow right now. This is when you call me in. And what I will introduce to you is a dealer in capital assets. Again, this is a qualified intermediary. The old term is accommodator, but he's a qualified intermediary. I will introduce that to the transaction. The very first step is that the seller is going to sell their property on an installment sale basis, interest only, for 30 years, and that interest rate is 5.7%. Let me say it again. The seller is going to sell their property to the dealer in capital assets on an installment sale basis at an interest rate of 5.7% interest only for a 30-year period. So right now, your seller is getting a 1099 every year for $570,000. 5.7% on 10 million is 570,000. So they will have that every year to pay taxes on. The next step, and this is probably the secret sauce to the whole transaction, is that the dealer in capital assets is going to introduce a private lender to your seller, and that private lender is going to give your seller a business loan for 95% of their sale price. So 95% of 10 million is 9.5 million. That loan is also going to be on an interest-only basis, but an interest rate of 6%. If you get your calculator out and you do 6% on 9.5 million, it comes out to 570,000. What your seller now has, I put 1098 there, but they don't get a 1098. Most people are familiar with that in the real estate industry. They will actually get a ledger statement every year from the private lender of $570,000. So up top, they're receiving interest of $570,000. Down below, they are paying interest of $570,000. The two will offset each other to zero. Also, the CPA will file a Form 6252, which is for an installment sale. So this is the guts of this whole transaction. Again, up top, we have the seller selling to the dealer Capital Assets, a qualified intermediary, on an installment sale basis only, interest only, for 30 years. They're also receiving a loan from a private lender. These are mezzanine private lenders of 95% of their asset. 95% on 10 million is 9.5 million. So they have a business loan and they have a note receivable. The third step, the dealer and Capital Assets will just go ahead and seamlessly during the course of your escrow, we're not going to lengthen the escrow or shorten it, but during the course of your escrow, we'll go ahead and sell that property to the buyer. They're just a pass-through. The buyer now has clear title as agreed to in your original escrow. Nothing changes. The buyer will sign a cooperation clause that will allow him, if there's any falsehoods in accounting or anything that is wrong with the transaction, the recourse is back to the original seller, not the dealer and Capital Assets. So that's what the cooperation clause will do. In that third step, the dealer and Capital Assets now has the $10 million, which was the original agreed to price. So during the 30 years, the dealer and Capital Asset will invest that money, and this is how they make money during a 30-year period. They're paying out 5.7. Anything they can earn over and above the 5.7% that they're earning, they get to keep, and that's how they make money over the next 30 years. So 30 years goes by, and the final step happens. The dealer and Capital Assets, remember they had the $10 million. They will pay off the $9.5 million loan that the private lender had put in place. That will trigger capital gains. So in 30 years, your seller will have to pay capital gains at that point. The $500,000 difference, the dealer and Capital Assets is going to keep as a performance bonus. And they only get to keep that after they pay off the loan. When I first saw it like this, my concern was 30 years is a long time. What happens if the dealer and Capital Assets is gone? Because that's a very long time. How do we ensure that everything happens like it's supposed to, or like I've stated so far? What the private lender has done is put 3 escrows in place to make sure this transaction is finalized as we've talked about. The first escrow is for all the monies that are being received by the seller, the money up top in step 1. All the money being received is being received by an escrow. It's a paper transaction. All the money being paid to the private lender is being taken care of in the second escrow. So your seller is not waiting for a check for $570,000 so they can turn around and write a check for $570,000. It's all being done. It's all being done through the escrow set up by the private lender. And then you have your final step down there where the final payment, the 9.5 million is being paid off. So all the money is held in escrow. The dealer and Capital Assets can only invest it and keep what they earn over and above what they're paying out. You probably want to take a picture of this if you're looking at it right now on your screen. This is the entire transaction. A couple things that I like to look at as an investment person, that's my core competency, is that for every $100,000 that we can save your client in taxes, if they could just get 5% on it, it's worth $430,000 30 years from now. Also, if you look at an inflation rate of 3%, which is pretty conservative, you end up discounting the tax by 60%, and you're dealing with 40 cent dollars 30 years from now. So the combination of those two make it a home run for your seller or for your client. The third bullet point there is kind of an extreme. You know, we have kids, like I said, this can be used for any asset. We have kids who create apps and sell them to Apple or whoever. And a lot of times their cost basis is extremely low. In the case of your clients, they may have used up all their depreciation. They may have a very low cost basis also. But that's an extreme case in California where a kid starts an app, sells it to Apple for 10 million, and his total liability is about 3.71 million in capital gains. We can make that go away. But the bottom bullet point there is more addressing your issue. It can be used as an alternative as a 1031 exchange. It can also be used to rescue a 1031 exchange in the 11th hour. And when I say the 11th hour, we need about a week. We got to draft the paperwork for the private lender, has to draft his paperwork for the loan, and also the DCA will need to draft his paperwork for the installment sale. And we like it that if the seller's attorneys and CPAs are involved in this transaction, because we want to ensure that your client fully understands what they're doing. For some of you people that may be recovering CPAs or enrolled agents, but now in real estate, you may think of this as a step transaction, and that's an accounting term. But let me tell you why it's not. And I can talk to your client CPAs on why it's not. There's also an IRS memorandum that's out there dated 2012 from the chief counsel of the IRS saying that this transaction is okay. But the reason it's not a step transaction is that there are three parties involved. The private lender and the DCA are not related parties. They're two different companies. And of course, the seller is a different person. Also, when you think about the client's balance sheet, it will reflect a note payable and a note receivable, as well as cash from a loan. In a typical sale, the asset's gone, the client has cash. That's another reason why it's not a step transaction, because none of the people are interrelated and the balance sheet does not look like a cash sale. So in summary, your client's going to receive a 1099 for the interest they received. It will be offset by the interest that is paid or a ledger statement they will receive from the private lender, and that's the transaction. So that's a 30-year deferral. I also want to let you know that there's a deferral that we can do in perpetuity, and I can discuss that with you on a one-on-one basis if your client wants to defer that on an even longer time frame. Thank you for being with me. My name is Eric Bell. You can reach me at eric.c.bell@exprealty.com. And my cell number is area code 949-201-6525. Thanks, Jen.